These mortgage myths could be costing you thousands. Let's bust these myths with the facts. Today, we're here with Nicole Ruth, the Ruth team at Movement Mortgage, and Nicole's going to help us do some myth busting today.
I'm all for it. Let's do it.
Thanks for being here.
Yes.
All right, so let's just do fact or fiction on some of these. Fact or fiction, you need really great credit to buy a house.
Great credit helps. You don't need it. So that's where people think, well, I have to work on my credit and I wait and wait and wait until I have perfect credit. You can get in, but it will affect your credit or your interest rate, and it will affect your mortgage interest. Or insurance, sorry. So many people don't think about that too, because that can add a couple $100 a month in payment in your mortgage insurance. So yes, great credit helps, but all you need is a 580 or above in order to get in. And then if you can optimize getting, especially in this market, where you can get the seller to pay for an interest rate buy down or all of your closing costs or a price reduction, and then in the meantime, you can be building up your credit and refinance when interest rates do go down and take advantage of that, that's set up for success.
Yeah, so 580 is the absolute lowest, but 580 will come with the highest interest rate. And then the more your credit goes up, then you can get a lower interest rate. And of course, the interest rate is based on so many other things, not just the credit score, but that's one of the things.
But I do want to clarify that 580 isn't actually the lowest. It's the lowest that most lenders go to. You can actually have VA doesn't have a minimum credit score required, and FHA will actually let you go down to 500, but you have to have a manual underwrite, and it gets very challenging to get somebody approved with a lower credit score.
Okay, so with a VA loan, any credit score will do.
Theoretically.
And with an FHA, we can go down to 500.
Yeah.
I mean, the bottom line here is we don't want you to feel like you're held back or to hold yourself back from pursuing home ownership if you know you have a lower credit score, because there could be options for you to get in.
Yes.
Yeah. And then, of course, you can work on your credit and refinance later.
Correct.
Just like work on your credit, wait for the rates to come down.
We're all waiting.
Fun. Yeah, we've been waiting for 2 years now, I think. All right, well, let's do it again. Let's do another fact or fiction. This is kind of what this is a lead on from the last thing. Fact or fiction, you should try to time your buy with the lowest interest rate.
That's perfect if your timing is spot on every time. But what happens is people continue to wait, and ultimately the prediction of what's going to happen with rates doesn't always happen. And so you find yourself waiting, and so many people were waiting, like during the pandemic. They were waiting for prices to stop going up, or they were waiting for interest rates to come down, or they were waiting for better affordability. And the further and longer you wait, the harder it is to get in. So it's better to not try to time the market, but to spend time in the market. You're so much further ahead when you can get in and let appreciation work for you, principal reduction work for you, tax benefits work for you. Timing interest rates is a challenging feat.
Well, nobody has the crystal ball.
No.
And there's just no telling what may or may not happen in the world and in the economy, and all of that stuff is changing them. They're changing. Do they change once a day, or are they changing multiple times a day?
Multiple times a day. Now, most reports come out in that 8:30 Eastern time frame. So that's 6:30 Mountain time. So typically interest rates will open up with the majority of the economic data that's going to be released that day. But if something happens in the middle of the day, somebody comes out and says something, does something, a late report comes out, interest rates can change multiple times a day.
Yeah, don't try to time your buy. It's just a losing battle. It's a losing battle, and on so many fronts. Number one, you can never really know what's going to happen. And then number two, you're missing out on, the appreciation of the home, paying down the mortgage, and the tax benefits, all three of those things that you mentioned.
Yes.
Okay, so what do we have next for myths? Fact or fiction, Nicole, you can't buy a home if you're self-employed.
That is fiction. That is fiction. We work with so many self-employed buyers. You just have to understand how the guidelines are written. So here's an interesting fact. If your business is more than 5 years old, and I'm going to look at the Secretary of State start date. So that's typically how we get when a business is started, is right there on the Secretary of State website. Or if your business requires you to be licensed as a real estate agent, I can go back to your license date. So that date is going to give us most common, those are the two most common ways where you get that date. If your business is more than 5 years old, typically I only need 1 year of tax returns.
Oh, not the 2.
Super helpful. A lot of times, because you have, as self-employed, your income, you're not on a salary. So your income is volatile. And so if you had a really great year this year, but the year before that wasn't as great, we could just do 1 year. Now, if your business is within 5 years, both Fannie and Freddie will ask for 2 years. So we'll have to do a 2-year average. So if that first year was slower, I have to average the two. But there are so many other programs that are 12-month bank statements, a P&L loan, or a 1-year tax return if your business hasn't been in business for 5 years. Those are called non-QM loans, non-qualified mortgage. And those are just really lenders outside of Fannie and Freddie. And they offer opportunities for self-employed buyers who might not fit inside that mold.
Yeah. I mean, yeah, there's a lot. There are so many loan programs
Yes.
that it feels like, there's a loan program for everyone.
Agreed.
Yeah. All right, let's see. What's the next one? Well, affordability is definitely an issue. So fact or fiction, you have to have a really high income to buy a house.
It feels like that right now.
It feels like, yeah, that's what I said. Like affordability feels unaffordable.
It feels unaffordable right now. Obviously, the higher your income, the more options you have when you go to purchase a home. But there's so many things that we can do with a lower income. A lot of times you might have a cosigner, that a parent or a sibling that might be willing to cosign for you to help you be able to afford a home that you think you can pay, but maybe your income doesn't support that. Or a lot of times you might be in a partner relationship and the other person has a really low credit score and they can't be on the loan. And so you're only qualifying with one income, a parent or sibling or somebody else co-signing, supporting that household could be a great solution. Another solution today we're seeing a lot more of is co-living. So co-living is where you might have several people that are going to roommate together. They've been living together and now they're going to own a home together. If you're not married, the only thing that I would say is that you should have something written and notarized. What happens if this thing falls apart?
Yes, yeah, and I mean, you're talking so specifically to me and my polycules here.
Yes.
We've closed a couple. In fact, we have an active one shopping right now, and it's a group of 4 who are, they're all adults. They've been living together for years, and now they're going to buy a house together. And so it becomes these conversations about, who's on the loan, who's on the house,
Yes.
what does that look like? And then, as you mentioned, this whole idea of having a cohabitation agreement,
Mhm.
and then either in addition to that agreement or separate from the whole agreement about what is happening to the house. If people break up, if they need to move for job or family, if whatever, like what happens if somebody needs to leave that situation, and what are they agreeing to? Like, are the others able to buy them out?
Mhm.
Is it going to end up forcing a sale?
Yeah.
So it's a lot of conversation to be had. And I actually recently found out that the lawyers, I thought a cohabitation agreement was something that, I mean, I found one on the internet and I was like, this is great. And I kind of thought it was not a thing, but it is a thing because the lawyers are making cohabitation agreements.
Yes.
Like this, you can go
Yes.
to a lawyer to
Yes.
get that.
And you should, because
Yes.
if you're not married, you can't get divorced, so you'll have no legal process. So set yourself up for success in any kind of partnership, right?
Mhm.
Set yourself up for success. If the situation changes, how do we? And it changes because if somebody's on title but not on the loan, I can just quick claim them off and maybe they're owed some amount of appreciation percentage. Or if they're on the loan and on title or not on title, well, now I have to refinance to get them off. Now, there are some loan types that you can assume. So if they're buying it with an FHA loan, it very well could be that the other parties could assume the loan and keep the interest rate versus having to refinance.
Well, and the other parties have to be able to qualify for the loan.
They do.
To be able to assume it or to refi it. Either way, that's a consideration too, because what if one of those parties is now no longer working? Then you can't, it's so difficult, I think, to get qualified for a loan if you don't have any active income, right?
A little bit challenging.
Yeah. Yeah. I mean, you would
Although
have
we
to have a
have-
ton of assets.
I was literally about to say,
Yeah.
we have asset-based loans.
Right.
Mhm.
So, something that we didn't talk about that also impacts that is that if you don't have any debt, you don't need as high of an income because,
Right.
why don't
Yeah.
you?
So if you have, say you have $10,000 a month in income, $120,000 salary. It's really easy because it's easy math.
Yes.
So $10,000 a month in income, typically on a debt to income ratio, we're looking at a maximum of 50%. So that would be you have $5,000 to spend on all your debts, the debts that we see on a credit report. I'm not going to look at your cable bill or other things that don't fall on your credit report. So if you've got a lease payment of $900 and you've got credit card bills of another $1,000 and you've got some student loans of $500, I start adding that up and I only have what's left of the $5,000. So now with all of those, and I don't even know what numbers I just rambled off, but you might only have $2,500 or $3,000 left over in order to buy that home, which is going to typically be challenging versus if I have $120,000 income, $10,000 a month, $5,000 I can spend on my debts. If I don't have any other debts and I've been able to manage that, even if I have a small car payment, I can still get a house loan. Theoretically, I might not want one this high, but theoretically I could get a house payment of $4,500, $5,000 if that fit within my budget.
Theoretically, right?
Yes.
What do you know off the top of your head? Is there kind of a number that's like, you need to be making at least X, and let's leave the debts out of it because we understand how those decrease how much you can pay for your monthly amount. But do you have an idea of you really need to be making 50,000 or 75,000 or something to get into anything?
There isn't a specific number because HOAs have skewed what somebody can afford at the lowest price points so much.
Yeah.
Because it used to be that you could say, well, on a $50,000 income, let's go to 60,000 again, because I'm just talking easy math. 60,000, you're talking $5,000 a month, so I can afford $2,500. $2,500, maybe you could get a $2,500 month payment with a $280,000, $250,000 purchase price, but now you can't because now the HOA dues have gone up. They're not a couple $100 anymore. They're $300, $400, $500 a month.
Right.
So it's really hard to say that, but definitely talking with a lender and looking specifically in that price point in your metro. So you might be okay living in Colorado Springs or Aurora, or you might say, no, I only want to live in Littleton at that lowest price point. The HOAs might be different as well. And so really knowing what is the exact purchase price with what HOA, what is my maximum? First, you boil down to what is my maximum monthly payment? That's the first number you should know. And then based on that monthly payment, what's the combination of purchase prices with HOAs if you're even looking at anything attached?
Right.
Yeah.
And all of this just rolls right back around to, if you are not already in real estate and you think you want to buy something, then talk to a realtor, talk to a lender. Those are your first two people that you start interviewing, and interview them. Don't just hire the first person you think of, unless it's me. Okay. Sorry, I just had to throw that out there. But the bottom line is doing the mortgage application and uploading all your documents so that the lender can look at your specific situation and tell you, this is your max monthly payment, here's what we can and can't do, because it just is so different for everybody. Everybody has so many different debts, different credit scores. So the best thing to do is just to fill out the application, upload the docs. And you know what? This is a perfect time because I just saw some news that you released, maybe even just this morning, about
Oh, the Trigger Act. Is that what you're
Yes.
talking about? Yeah, the
Yes.
credit.
So, I used to tell clients, or I still am telling clients, like, do this opt out thing before you start applying for mortgages. Because as soon as you apply for a mortgage and the lender processes it, does a
Yep.
pull on your credit,
Mhm.
your information was getting sold everywhere and you were getting spammed with calls unless you had done the opt out thing first.
Right.
And so now that's no longer a thing.
As of March 5th, they're giving them 6 months to roll it out.
Okay.
But the clock is officially started.
That's great.
It is fantastic news. It's way overdue. And all that is the credit bureaus, and it still happens in other industries. So I would still say that if you don't know what an opt-out is, you can Google it. They're federally backed websites that allow you to opt out of your phone number and your email to stop getting spam, because the credit bureaus, Experian, TransUnion, Equifax, have the legal right to sell your public information. So nothing private. But if you go shop for a car and the car dealership pulls your credit, then you're going to get a bunch of offers from a bunch of other car dealerships. Same happens as with mortgage lenders. Same happens with healthcare, insurance. So there's a lot of other industries that are still doing it. Regretfully, I don't know why. I'm happy that this law happened, but it was really identified and isolated to mortgage lending.
Oh,
It
interesting.
was. So the rest of the solicitations are not ending. So you should still put yourself on the opt out.
Okay.
And so I still use it as an educational piece that people should do that just to stop spam. And you have to do it every 5 years.
Oh, I didn't realize that. And
Yeah.
I was also just going to mention that if you're shopping lenders and you want to fill out a couple of applications and talk to a couple different people about what they
Mm-hmm.
can do, you really want to get that done within about 2 to maybe 3 weeks, doing that all in the same time frame, because then it's only going to hit your credit as one hard pull.
Yeah.
So just to be aware of that.
Now, most lenders today use soft credit pulls, so it doesn't even affect your credit. But if the lender is doing a hard, it does. 100% it does.
It depends on the lender, because I just had one the other day that we got on the phone and the lender was like, "Oh yeah, I already did the hard pull. That's the gold standard of a pre-approval. Like, of course I'm doing the hard pull." And so it just depends.
It does.
Everybody does their work their own way.
Agreed. Agreed.
All right. This is the last fact or fiction for
Okay.
these mortgage myths that we're busting, because these myths are keeping people from getting into real estate and are costing people so much money. So fact or fiction,
Okay.
you need 20% down to buy a house.
You don't need 20% down. I love this one because everybody has that in their mind because of the mortgage insurance. So at 20% down, mortgage insurance falls off. And so people don't want to pay. And I get it. Nobody wants to pay for somebody else's insurance, because ultimately mortgage insurance protects the lender, not you, in case you default. But the amount of money that mortgage insurance actually costs can be quite minimal. Like if you've got great credit, you could have mortgage insurance on a monthly basis of $48, $50. Like it doesn't have to be hundreds.
I was just going to say, I saw a cost estimate just in the last couple of days, and the mortgage insurance estimate was like $48. And I didn't realize, because in my mind, I guess I thought that that was like a couple $100 a month, but
Yeah.
I was like, oh, it's only $50. It's way less than an HOA.
Yeah. It depends on how much you're putting down and your credit score and your debt to income ratio. All three of those get factored into mortgage insurance premiums. And then you might find that you need, because you've got a lower credit score, you might need an FHA loan that has mortgage insurance the entire length of the loan. So that's an irrelevant conversation. And VA only has an upfront fee. It doesn't have a monthly mortgage insurance. So if you're a veteran, you have absolutely the best program available to you, no money down. So typically getting in with the right amount down, partnered with what your budget is, right? So what do you have access to? I have this conversation with a lot of people who maybe they do have a little bit of money. Maybe they've been saving for a long time, or maybe they have family money that they can get as a gift. Trying to decide what is that right amount. And a lot of times it's what is that optimal payment for you for your budget? And then let's back into everything else. Let's back into the right down payment. Let's back into seller credits for an interest rate buy down and all the options. But you can get in with as little as 3% down on a conventional, 3.5% down on an FHA, 0 on VA, and 0 on USDA. And then jumbos typically will want to see 20% down, but we have as little as 10% down on those.
That's great. And actually, we're going to dig into this a little bit more on another episode where we're really talking about all of the facts that go along with this idea of buying a house with less than 20% down. Like, what are all the things that you need to know? So definitely check out that episode. But for this time, I think we've given people a lot to think about, and hopefully we've busted those myths.
Yes. Because really, there should be nothing that stands between you and home ownership. And if there is, you want a plan in place. Like, what is it going to take to get you into that opportunity? Because ultimately, when the right home shows up in the right life circumstances, you want to be able to make that decision with all of the information at hand.
Yeah, you're so right, because that, I was saying earlier, if you're thinking about it, then definitely pull the trigger on doing the application so
Yes.
that we can, get a complete picture and see what is possible. And then the next thing becomes, well, if it's not possible or it doesn't feel right now, what are our next steps in getting that plan in place for, when will you be ready? You will never feel ready. I saw this. Being ready is not a feeling, it is a decision.
Oh, I love that.
Yeah. So
It's a decision.
you will never feel ready to buy the house, maybe, because it's so much. It's a big deal. It's such a big deal. But you can choose to be ready by doing some pretty simple things like talking to the professionals
Yeah.
and figuring out what is your plan. Yeah.
And you'll feel more ready the more prepared you are. I just talked to somebody this morning who wants to buy in April. I mean, that's a number of months from now, but he just wanted to make sure that he was saving up enough, that he had the right strategy in place, and that he knew that when the right place showed up in April, and reason his April is because he bought a single family home this past April. And so he's going to live in it in a year, and he wants to buy a multifamily for the next one. And I love it. I was so all in on that conversation.
Well, and everybody has all their different reasons. Eric and I talked with a client of mine who, is planning to buy in 2027. And because she just got certain things going on in her life that make it that, that's when she'll be ready. There's a lease, there's children in school, so we're not sitting here, berating anyone for not doing it now. Although that's our recommendation. Our recommendation is always to do it now rather than later. But
Yeah. But with a plan, you can feel more ready
Yes.
to make the decision.
yes.
Yeah.
All right. Well,
Yes.
we've got Nicole Ruth from the Ruth team at Movement Mortgage. She's one of my go-to lenders. And thank you so much for being here today.
Absolutely. So fun.
If you like this content and want to support the channel, don't forget to hit the like, subscribe, and alert bells before you go.